Better late than never, especially when it comes to doing this live stream. Welcome. I'm Mitch Goldberg. You're watching my live stream. Be the boss of your money. Be the boss of your money means it's about taking control of your personal finance. We're all striving to be the best we could be. We want to be physically fit. We want to have a happy social life. Just you want a good life, but I think the financial part of it is a key component. It pervades everything. Money is the root, or as my grandmother said, money is the root of all evil. But I have evolved to say not having money is the root of all evil. That might sound a little greedy to you, but when you are in a safe, secure position in life, you're also in a position to grow a business. You're in a position to help others. There's so many good things that come out of having good personal finance hygiene, right? So that's what the show is called, why I call it Be the Boss of Your Money. So you could take control of your money, not your money taking control of you. It's very easy for that to happen. We're going to get into the silver lining of a recession. And I've been saying this for a long time now. I do think we're in a recession right now. Uh, it's still pretty mild because the big statistics like the unemployment rate haven't fallen yet, but the leading indicators that indicate that, like rescinded job offers, which is becoming pretty widespread, that's when you think you're going to your new job, next week and everything's great, and then they call you and say, "Yeah, we're rescinding the offer. We can't offer the job anymore." In the meantime, you just quit your job to go to this new job. So that's happening, but the number of openings is starting to decrease. Housing sales, home sales is the weakest it's been in years. Mortgage rates have jumped, putting a crimp on real estate markets in in what were formerly very hot markets um, from Texas, Austin, for example, Nevada, Florida, just the same places that always build up fast and then take a hit. I was speaking to my friend Michael Wright. He's a realtor, a longtime realtor, successful realtor with Douglas Elliman. And he said, listen, there's two things to look at. There's the inventory and demographics, which shows that there's still demand for housing. And then there's the economy and interest rates. Which one should carry more weight? They both carry a lot of weight, okay? But, he said, banks are not in bad shape like they were. And I agree with this. Banks are in better shape than they were in 2008, the last time we had a housing market crash. Okay, so 14 years ago, I can't believe 2008 is 14 years ago that we were in the midst, the worst part of the worst recession since the Great Depression. uh, but banks are in much better shape. The weird loans, the ninja loans, you remember the term ninja loan? No income, no job, no assets, ninja. Those were very popular. Interest only loans were very popular in 2008 or leading up to 2008. Banks have become much more strict in terms of who they give credit to, in terms of who they would give a mortgage to. So the banking sector is in much better shape. In fact, the banking sector is in excellent shape. It's just that housing, home prices are a reflection of cost. People can afford to pay a certain amount per month, a payment. Interest rates go up, the payments have to go up, which means you buy a lower cost house. Or it means that sellers who thought they were getting top dollar for the house are all of a sudden realizing, I'm not getting top dollar. I have to start lowering the price of my house, or else my house is just going to be sitting in the market. So that's the situation, which is why I do think home prices go down, but I don't think they crash. I don't think we're seeing 20, 30, or 40% decrease nationally in the cost of houses. Maybe certain markets could see a disaster like that, but I generally think cost of houses goes down a little bit. It takes a while to recover, but there's still a whole generation of millennials and Gen Zers who would like to buy a home, and there's just still a shortage of houses. So um, it's tough to say how much things go down. It's like forecasting the future. Forecasting is easy except when it comes to forecasting the future, right? So that's a big thing, and it's housing is such a big part of the economy. Today wasn't all of it. I don't really want for today to be just about housing, but I just want to let you know we're looking at the silver lining of a recession, and as the belief that we are in a recession or heading into a recession or getting very close to heading into a recession, super close, it's changing some things all of a sudden to thinking that maybe the Fed can't raise rates as much as it thought, and long-term interest rates have actually started to back off. Even the mortgage rate that just jumped to over 6 is starting to back off, come down a little bit. So if we do go into a recession, means that maybe the Fed can't get out of its giant bond holdings like we thought it would. It changes the impetus for investors. Now, I'm not saying that a recession is great. I'm not cheering for it. But remember, the economy and the stock market are different things. And if we start to perceive that the Fed's hands are tied, the Federal Reserve, that could be an indication that stocks are sold off too much. Companies are still making money. Now, granted, maybe not as much, but there's still a lot of values out there. And if if the Fed is perceived as closer to the end than the beginning of its tightening cycle, that would be very bullish, I believe, for the stock market for investors. And that's what you're starting to see now. So the situation changes. Last week we're so overwhelmingly negative. This week we're starting to think, hey, great, we're in a recession. That means the Fed has to stop. Has to stop rate tightening. So this is the tug of war. And then we talked about soft landing versus hard landing. If the Federal Reserve has to bring down inflation, it has to slow down the economy by raising rates. If it does that without sending the economy into a recession, it's called a soft landing. If the economy goes into a recession, it's called a hard landing. Last week, we were talking about how we can't avoid a hard landing. That's what all the pundits were talking about. This week, the focus is on the ones who are saying we might not even have a recession. We might not be in one. So we have these counter opinions constantly coming out. But I'm going by the numbers. I'm going by interest rates and the stock market. That's the tell for me. And both of those are telling me that we are closer to the end of the Fed tightening cycle than the beginning. And that is actually very bullish for investors for the stock market. That's the big story today. That's the downside or the silver lining to the recessionary clouds. So let's do this. Let's just put the banner up here, and I'm going to just roll the quick intro with some disclaimers. We do this every day. I'll be right here, so stick around. If you have any questions, please hit me up in the comments. Words of wisdom, words of encouragement are always appreciated in the comments. And if you don't mind, give us a thumbs up, an applause, a wow, a heart, a support, whatever it is, depending on which social media platform you're watching me on right now. So here's the intro. Be right back. All right. Thank you so much for joining me. We're talking about the silver lining of a recession. And this brings me to another thought. I had this thought that, the only thing worse than consumers who are just getting creamed, crushed by high inflation is a consumer who gets laid off. The only thing worse for them. Did I say that right? The only thing worse for a consumer besides high inflation is no job, getting laid off. That is the worst thing. So the Fed's worried about high inflation, but the Fed could also start causing job loss and recession. But that's part of the cycle. And, a lot of people feel that the Federal Reserve just kind of causes these ups and downs with trying to manage the economy through raising and lowering interest rates. It's the Fed's trying to manipulate the economy, and it gets too hot, it raises it raises rates. If the economy runs too hot, inflation goes up. You see the effects of inflation, and then we have to raise rate. The Fed has to raise rates and slows the economy. And if the inflation rate, well, let me know if you can hear me okay out there, guys. If you can't hear me, I'd be really bummed. That happened to me a couple days ago. Like, you know, the volume just didn't come through, and I was really upset about that. But if the economy cools down, the Fed cuts rates. But what if the Fed was just out of the way and the Fed just really acted in its capacity as a regulator of banks keeping minimum financial ratios to make sure that they are safe and battle hardened in the event of a market or financial or economic calamity, and make sure that the banks are following the rules that keep them financially sound and that protects the public. Maybe the central bank of the United States, the Federal Reserve, maybe it shouldn't worry about inflation and employment. It should just do its job as the overseer, as a regulator of the financial services industry, and maybe the currency. It's the Office of the Comptroller, but of the currency, U.S. dollars. So we are going to be debating this a lot because we go through these boom cycles, these booms and busts in the economy and in the stock market. And every time we come out of it, the Federal Reserve is more high minded, more battle hardened, more experienced. I'm just trying, I don't have a great term for it. The Fed is more confident in terms of how it could manage our economy because it always learns a lot from the last calamity. But we keep going into these booms and busts. So maybe there's just really no way to learn from a market calamity. And it's just that, let the free market take care of whatever interest rates, inflation, and employment should be. Right? The Federal Reserve came around after the Great Depression to help prevent another Great Depression, to help prevent a complete collapse of the banking system and the economy, and to create regulations to better manage banks. Because if you put your money with a bank, you expect the bank to be a good steward of its capital. Because if it's not, then it's not really being a good steward of your capital. We could debate this, and I think there's something to be said. Only the federal, brother. I see a few of you out there. I see Garrett is out there. Leah, thank you very much. Leah, you are a new connection for me, so we definitely need to speak. And thank you for joining me, Dr. Jarkin, right? I hope I pronounced that properly. And so these are going to be things that politicians, bankers, investors, we're going to be debating this. Having said that, whether if we are in a recession or not, it appears that the economy is weakening. There's just a pale of negative, pale, I don't know if that's the right word. There's just this giant amount of negative energy amongst consumers and investors. So maybe, the thinking is if you think we're going into a recession and you act like we're going into a recession, if we all do that, we cause a recession. Because when I stop spending, if I slow down my spending, it's my savings that I save more money. It's good for my personal balance sheet. But my spending is somebody else's income, somebody else's living. If we all decide to cut back at the same time, and remember, consumer spending is 70% of the U.S. economy, that could cause a recession. Psychology does have a lot to do with how markets work. Money is emotional. We've talked about this. Money is very emotional. Behavioral finance is a pretty cool topic. If you ever want to get into that with me, I'd love to. So the silver lining, though, is, and I'll give you an example. The chairman of the Federal Reserve, Jerome Powell, said 2 days ago in his congressional testimony that he sees the odds of recession rising, and it's a distinct possibility, but he is committed to squashing inflation no matter what. If that doesn't tell you that the Federal Reserve is willing to let the economy go into recession, I don't know what does. But every time we get to that point, the Federal Reserve backs off, stops the tightening cycle, and indicates that maybe they overdid it, and then investors get excited because if interest rates could go down, stock valuations go up, the market goes up, right? High interest rates lower expected future earnings when discounted to today's dollars. That's why you see stocks with high P ratios get hit first, get hit the hardest. A stock with a high P ratio means that investors are betting on the company making a lot of money down the road, even if they're losing money now or making very little money now. A high P ratio of a stock is usually an indication of confidence in a company's ability to make a lot of money down the road. By the way, when you invest, I just want to say this real quick: the S&P 500, the Dow Jones, and Nasdaq Composite, the Russell 2000. These are all stock market indexes. You cannot invest directly into an index, but you could invest into a security that tracks or mimics an index. So let's take a look at the boards and see how things did. I'll pop myself up in the corner. Dow up almost 200 points after being down about 48 points yesterday, but up over 600 the day before. So continuing on a pretty good week, a little bit of a bounce back continuing this week. It's a good week for investors. It's only a 4-day week. Remember, stock market was closed for Monday for Juneteenth. So it's a 4-day week. Nasdaq up 180, S&P up 35. Hey, I'll take it. Gold continues to go down. Why? Because if the Federal Reserve is tightening and reducing the amount of dollars in circulation, that is not good for gold. But gold has never really done anything throughout this last decade. It's just been a waste of a asset. I know it's a hedge, but hedges cost you money. I'm not really a big hedger. I feel that if I'm investing for the long term, I don't really need to hedge, because what's the difference if my portfolio goes up or down over the short term? I'm not changing anything. In fact, with this market the way it is, I've changed so little with my own personal accounts and my clients' accounts, because the bear market we're in now, the expectation of this bear market has already been built into my clients' expectations, your expectations, right? Into their portfolios of what the possibilities could be. We've already done that. So if anything, it's a matter of rebalancing, maybe sell a few things that have worked out, buy a few stocks or ETFs that have gone down in value. And that's we're just continuing on the same path. And of course, money is invested based on one's age, financial goals, and time horizon. Your time horizon is what determines your risk tolerance. The longer you have, the higher your risk tolerance could be. 10-year yield, let's look at that. The 10-year down to 308. So yields are coming down. And let's look at the VIX. VIX is barely up today, but still, you see that? Up 20, still under 30. All right. So the VIX is a fear gauge. It just means that it tells you that when it goes up, it tells you that professional investors are willing to pay more money to hedge their portfolios because they get worried. Long-term hedging has a pretty big cost. So if you're a long-term investor, I'm not really into the hedges. I think what happens is that money managers get uptight because they see their portfolio returns going down, and they're worried that their clients, or their investors, will see that and say, "You're no good anymore. I'm taking all my money out." So then money managers start to manage more for managing volatility. They want more stability, and they're giving up on long-term returns that their clients need to retire one day, to pay for their financial goals down the road. The idea of investing is you're probably not going to accumulate enough assets just on saving money and just on keeping your money in a savings account. You invest the money into the stock market, because the stock market is where you could put your savings money, which then turns it into investing money. But the stock market has historically given you a return above and beyond that of long-term inflation. So it's not just putting away, $1,000, $1 million. Let's use real numbers. It's not like putting away $2 million, and in 10 years, the $2 million will still be worth $2 million, because the cost of everything in 10 years is going up. So your $2 million might only buy $1.5 million worth of goods and services, for example. But if you invest it, maybe that $2 million will turn into $2.5 or $3 million which will help keep pace with inflation. So that's why we invest. Keeping money in a savings account long term for many of us is just not enough of a return. So we look for growth of our assets. All right, that's like the whole ball of wax behind investing. And hey, James, I see you out there. James, thanks so much for joining. James is my new partner in the business. I'm his new partner in the business. We're doing a lot of collaboration, and we're going to have more about that. And I think we're gonna have James. I think we need to have you back. James has been my guest on this live stream in the past. We need to have you back and talk about our new partnership. It's really exciting, and just I figured out what you are. You are a nice guy in the exterior, but a total tech nerd on the interior, which is just like perfect. It's exactly what we need. So thank you very much. All right, let's take a look at the bond market. All right, let's take a look at bonds. So this is what I was talking about. Yields on the 10-year down, the 30-year down, the 20-year down, but the 2-year was staying a little flattish. So the 2-year 302 versus the 10-year, which is 309. The yield curve is so flat right now. If that's not indicating that investors are worried, I don't know what is. And that tells you that the economy is losing steam. Let's take a look to see who's out there. If we've got something in the comments, I see one now. Okay, we got a thumbs up. Okay, so you are just giving me the thumbs up to what I just said. So thumbs up right back at you. Thank you very much. And let's take a look at crypto. I'm getting a little tired of talking about crypto because it's not something that I'm really. I mean, I think the topic was fascinating, but it's kind of lost its allure to me a long time ago, and I think there's so many shysters, so many scammers, and people talking it up. It's become such a greater fool theory game, and it's just not really what I'm into. So it was down to 17,000s last weekend. Now it's almost 21,000. It just trades all over the place. What can I tell you? I don't think Bitcoin is some magical currency. I don't think it's some magical beans or some magical hedge against inflation. It's just not what I'm thinking. Let's take a look at Doge. I look at that sometimes because it's a joke. It started as a joke. It's 6 cents. Elon Musk touted it, and it went up to 70 cents. And I was railing against that because people start to believe in that. If you see, well, Elon Musk buys it, it must be good. So there are a lot of people who don't have the financial sophistication to understand what they're buying, so they just imitate what somebody else does. But when you're imitating the wealthiest person in the world, to someone who money is no object, you really need to make sure you're doing what's best for you. It's kind of like when people are asking me if they should buy Amazon. Amazon recently split a 20-for-1 stock split, and people are asking me, and I'm sure most financial advisors or many got this question. Should I buy Amazon because it's split to 20-for-1? And the answer is it depends. Is your goal to own Amazon stock? Some people say yes. Okay. Why? To make money. Well, what's the goal? What problem are you trying to solve for? Trying to make a long-term return above and beyond inflation? Maybe Amazon could do it. Amazon it's a stock. It's a tool. And there are lots of tools to build the portfolio to, in turn, give you the returns that you desire, the potential returns, I should say, that you desire to meet your financial goals. So we need to look at it that way. So I start with the goal and work backwards to now. I start with the plan. I start with the final product, and I work backwards to now to determine which supplies, materials, and tools that we need to build the plan, as opposed to starting with Amazon now, because that somehow becomes your only tool or one of your only tools. And people who bought, we talk about these all the time, people who got into Facebook, I'm not talking as part of like an index or something, but I'm talking about people who just bought or put too much money into the FANG stocks. They bought too much Facebook. They bought Amazon, Google, which is Alphabet. Okay, Facebook is Meta, Netflix. Right? I'm not knocking those, but If that was your entire portfolio and you're down like 40% from a peak, you're like, how could this happen? How could these stocks go down so much? Because you didn't use the right tools. If they're a part of a portfolio, it's a different story. I'm talking about people who just binged on technology and tech related stocks. I know they're getting smashed and they're paying the price. And this happens every generation. This happened in year 2000 also. It seems every 20 years or so, we go through this realization and learning curve of investing. That's why when you listen to people like me, who's older than a lot of you, I'm 55. Um, that is why you should listen to people with experience, because I've been through it and I know how it ends. And as great as you think it is, you can't miss. It's the you know, crypto is the currency of the future. Like Dippin' Dots is the future. Is like just like Dippin' Dots is the ice cream of the future. It wasn't the future of ice cream. Dippin' Dots is just some stuff that you buy at a carnival. I still like to just buy regular ice cream, like vanilla, chocolate, strawberry. I don't even know what the heck I'm talking about. Now we're talking about crypto. We're talking about investing. Okay, so let's get back to the main camera. So that's my story. I'm sticking to it. We don't want to give up the faith. Investors, you'll be okay. The worst thing that I think you could do is to stop investing because the market's down. Now, if you have a question about your current holdings, some of them may be worth selling even at a loss. There's no rule that says the there's no rule that says the investments that you make your money back has to be the same investments that you lost your money on. Like if you're down on SPACs, for example, special purpose acquisition companies, no one says you have to make your money back in only those. You have to stick with them. You just have to see what are the best tools for the goals. And it's always a good time to do that. It's very enlightening, and it does take a bit of courage to let go of a stock. Amateurs hate to sell a loser. Professionals love to sell a loser. That's just the way we roll. All right. So if you have any questions, reach out to me. But thank you so much for watching. And let's see. We'll see what tomorrow brings. If I usually don't air a live stream on Fridays unless something funky happens in the market, like a really bad down day. So if it's a not too bad of a day tomorrow or a good day, I'm not going to do the live stream tomorrow. And that's about it. I'll see you Monday. All right. Have a good weekend.